we need to talk about a rarely discussed but important topic in the investment space. Securities lending within ETFs, meaning how and to what extent fund providers in Europe lend out the stocks they hold inside the ETFs we're investing in. To do that, we'll take a closer look at 6 popular fund issuers: Vanguard, iShares, SPDR, Invesco, xTrackers and Amundi. The differences I discovered were quite remarkable. Some of them have a very conservative approach, while others seem to be a lot more aggressive when it comes to lending, something that unsurprisingly seems to closely correlate to whether or not a fund provider, usually via an affiliated company, is taking a cut of the revenue. You'll of course also find out how security lending works in the first place, if it's something worth worrying about, and if we as investors actually end up benefiting from this common practice. By the way, this is not to be confused with share lending on a broker level, which I've talked about before on the channel, and is the primary reason why I've stopped using DeGiro and moved to interactive brokers and Trade Republic instead. Speaking of that, you can find those two linked down below if you'd like to support me. Alright, before you look at how security lending works in practice and if there are any risks, you're probably wondering why fund providers do it in the first place. It's pretty simple really. The goal is to improve the ETF's overall performance by generating extra revenue from the stocks or other securities like bonds that are being held within the ETF. In this video, I'll exclusively focus on ETFs containing stocks though, since my wife and I have been investing most of our savings into this asset class for the past 7.5 years, and I don't want this video to get too long or overly complicated. Since the vast majority of the revenue an ETF generates via securities lending is added to the fund's performance on an ongoing basis, we as investors ultimately end up benefiting from this practice via slightly better returns, usually an additional 0.01 to 0.02% per year for globally diversified ETFs. Of course, this statement assumes that all of this carries zero risk, which is not entirely true, so let's finally take a closer look at how security lending actually works and what protections are in place. I'm going to use an illustration from State Street, which you probably know via their SPDR ETFs, to illustrate this process. The fund, in this case the lender, works with a lending agent, which can either be an unaffiliated bank or an affiliated company. Don't worry, we'll get to the details for each fund provider later on. The lending agent has to ensure that shares are only lent to trustworthy, highly rated borrowers. Based on my research, we're talking about large international banks as counterparties most of the time, and that the borrower hands over collateral usually worth 105% or more of the share's current market value, with daily checks to make sure that the loans are always over-collateralized. This collateral needs to be highly liquid so that it can be instantly sold if needed, in case the borrower fails to return the borrowed shares. As a result, the lending agent gets access to highly rated government bonds or popular stocks in exchange. In the latter case, the collateral tends to be a bit higher, up to 120% based on what I've seen. At the same time, the borrower pays a fee to borrow the stocks to the agent, who takes a cut and forwards the majority to the fund. Any dividends during the lending period go directly to the fund. Okay, now you know the first two layers of protection. First, careful borrower selection to make sure they're of the highest quality, and second, 24/7 access to highly liquid collateral worth 105% or more of the share's value, which can be sold at any time if the borrower fails to return the stocks for whatever reason. Luckily, there's a third layer as well. In the extremely unlikely event where the borrower fails to return the shares and the collateral drops below 100% of the stock's value, there's an additional protection called borrower default indemnity. In simple terms, the lending agent itself guarantees to fully replace any missing shares in such a worst-case scenario. The 6 fund issuers I'm talking about today all have these 3 layers of protection for their lending activities. As you can see, while nothing in the investment world can ever be considered completely risk-free, any potential risk has been mitigated as far as possible, so in my opinion it's ultimately not worth worrying about too much. Even still, some fund providers are more conservative when it comes to lending, while others are a lot more aggressive in their approach. Let's compare and see if we can figure out why. Let's start by looking at the lending agents used by each asset management firm. Vanguard uses Brown Brothers Harriman, which they're not affiliated with, Invesco, the Bank of New York Mellon, which they're not affiliated with either, while SPDR, iShares, xTrackers and Amundi all use affiliated companies as lending agents, which basically means that the parent company is taking a cut of any such revenue. I wonder if that makes a difference between how much we get as ETF investors and how much goes to the lending agent. As you can see here, it obviously does. Neither Vanguard nor Invesco take a cut for themselves, with 93% and 90% of the revenue benefiting ETF investors, and only 7% and 10% going to an unaffiliated agent to pay for the service and likely the default indemnity protection. Meanwhile, SPDR is sending a much larger 25% cut to its affiliated agent, iShares the most at 37.5%, Amundi as much as 35%, and while xTrackers ETFs used to give as much as 30% of their lending revenue away in the past, that has been lowered to 18% in February of this year, equally split between Deutsche Bank as the lending agent and the portfolio manager DWS. Now let's take a look at the maximum that can in theory be lent out by each fund provider and the reality, meaning how much in percent of 25 popular ETFs were actually on loan over the past 12 months or according to the latest yearly report. I was a bit surprised to find out that in theory, as much as 50% of a Vanguard fund could be lent out according to its ETF prospectus, but luckily the asset manager is very conservative when looking at the actual amount, with my largest holding, the FTSE All-World, only lending out 0.8% of its assets and its S&P 500 ETF going as low as 0.02%. By the way, Vanguard was the only one where I had to calculate these numbers manually since they don't show them in percentage terms anywhere for whatever reason. I got these numbers using Vanguard's latest annual report from June 2023 by dividing the value of outstanding securities on loan with each fund's net assets at the time. I'm happy to report that Invesco is clearly taking a cautious approach too. Its FTSE All-World, which I've recently started buying instead of Vanguard due to its lower fees, only lent out 0.8% on average as well, while one of its largest physical ETFs covering the Nasdaq 100 had a low average of 0.9%. Looking at SPDR, aka State Street, we can now see that the average on loan is increasing to 2.4% for the MSCI World, 2.5% for the All Country World, 3.9% for the All Country World Investable Market Index, and as much as 16.5% on average for the MSCI World Small Cap. iShares is going further in some cases, lending out a significantly higher 3.9% of its S&P 500 fund, 10.1% of its popular core MSCI World, 7.6% of its MSCI All Country World, and 16.3% of its World Small Cap ETF. Meanwhile, xTrackers lent out 1.2% of the MSCI USA, 9.4% of its MSCI World, 5.5% of its MSCI Europe, and 1.2% of its emerging markets ETF on average. And lastly, we have Amundi. Here I would have loved to include data for its popular new Prime All Country World ETF already, but sadly that's not available yet, and due to the company's many fund mergers over the past year, there's not that much information to look at in general. Its closest ETF in what it covers is the Prime Global and MSCI World counterpart, which had an average of 7.6% on loan over the past year. So I'm assuming that Prime All Country World will likely be in a similar range. Two other Amundi Prime ETFs, Japan and Europe, lent out 12% and 16% of their holdings respectively. When looking at this table one last time, it does seem clear to me that fund providers are a lot more likely to lend out a larger portion of their assets if they're directly able to profit from it via their affiliated agents. Look, the risk of losing anything due to these lending activities for us as investors should be extremely low or almost non-existent due to all of the security measures that have been implemented. Having said that, part of me is still happy to see that the two fund providers I used to buy and hold ETFs covering the FTSE All-World Index, Vanguard and Invesco, have a very conservative approach to securities lending, with only 0.8% of their respective ETFs assets being on loan on average. I also like the fact that the two asset management companies seem to be the only one passing on as much of the lending revenue as possible to investors without taking a cut themselves, either directly or via affiliated lending agents. But now I want to hear what you guys think about this topic. How do you feel about securities lending within ETFs? Are you surprised by the differences between fund issuers? Let me know in the comments. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. You can find the best local brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. I'm going to add all of the sources I used for this video in the description so that you can review them yourself if you're interested, and also check the details for other ETFs I didn't mention today. Thank you guys so much for watching, have a wonderful day, and until next time.